Hello there everyone, interesting case today just been held in the courts about capital gains tax and what is deductible, particularly a profit share arrangement for developers paying a third party who helped them develop this property. So let's just have a little look at the basics of capital gains tax. Any kind of asset that you sell, you're going to have the same type of things appearing in a capital gains tax calculation, notably net sales proceeds, which is the cash that you've received, less what they call incidental expenses of the sale, such as estate agent fees, any accountancy fees to prepare capital gains tax calculations, and legal fees, solicitors' fees. You also are allowed a deduction for enhancement expenditure that's improved the building, like say you put on an extension, the things that you couldn't claim for as revenue deductions in your tax returns all the years that you owned the asset. Mind you, this enhancement has to still be there at the point of disposal. If you've put on an extension, then knocked it down in the years that you've owned it, and it's not in existence at the time you sell, then you don't get any enhancement expenditure. And also, of course, you get deduction against capital gain for the acquisition costs and the incidental costs of acquisition. In property, the largest one often being SDLT, and of course some more legal fees. Now, in this case, husband and wife had this property and they wanted to develop it. And what happened was, there was a guy who originally had spotted this opportunity and he was going to do it, but for whatever reason he couldn't do it, and he tipped off this husband and wife. He said, look, there's a bit of land over here, it's going to be worth a few quid, I think you should get involved and do this development. And they did, but one of them fell ill, and they came back to the original guy who told them about it and said, look, can you help out please on doing this conversion, whatever it was, I don't know what type of property, but they wanted to use this guy's expertise, and they said, look, we'll split the profits with you. So at the back end, we'll give you, I don't know, let's say it was 50% of the profits. So when it came to that arrangement, and they'd sold and developed this property, and they gave this Mr. X his share, whatever that was, however many tens of thousands. What they did then, they said, look, that expense to this guy, the profit share, they claimed on their tax return as a tax deduction against capital gains tax. Now, where would it have gone? Well, it can't be anything to do with the acquisition, because this was all at the back end. It can't be any enhancement expenditure, because that's not relevant. It can only be an incidental cost of sale. So these taxpayers said the payment of however many thousands to this guy was an incidental cost of sale. And HMRC said, no, well, it can't be, because these are the things, estate agents' fees, lawyers, accountants, profit share, you can't shoehorn that into any of this category. And the thing went to court, and the taxpayers lost. The tribunal sided with HMRC and they said, look, that profit share arrangement is not tax deductible. In theory, what you would do is you would pay your capital gains tax, husband and wife, whatever's left, and then, divvy it up, pay this guy, or that might have led to a more bigger percentage going to him because he didn't have to suffer any tax. However, the point is that the share that they gave off to this guy was not an allowable expense. Now, interestingly enough, and this has been sort of in a few tax journals recently, and tax commentators have said, look, had this have been dressed up differently, rather than a capital gains tax play, what if it had been in a limited company, a property trading company that does flips, say? Had that been the case, chances are that profit share would have been absolutely deductible, because you work out the profits on flips completely different in a trading company than you do if it's an investment asset under the capital gains tax rule. And so had it have been dressed up differently to begin with, they probably would have got that tax deduction on the profit share if it had been in a trading limited company. But as it happens, it wasn't, and it was individuals, and it was capital gains tax, and the capital gains tax rules forbid that kind of expense being deductible against capital gains tax. Also, it wasn't really mentioned a lot in the court, but I don't know how this guy who received that profit share, I don't know how he was, what he did about that, whether or not he put it on his tax return and paid any tax, because let's assume that he did, then of course you may have an issue here of double taxation, which seems a bit unfair. The fact that normally in a transaction between two parties, it's going to be tax deductible for one, taxable for the other on a lot of things. But this one, if we're saying, well, that's not tax deductible for this couple here, but this guy nevertheless paid tax over there, it's almost akin to double tax. But hey, that's just the way it is. That deduction was not allowed against capital gains tax. Like I said, had they done this thing differently, limited company might have been different. So, just an overview there of a recent court case and the non-deductibility of a profit share in a property deal. So, if you like this video, please do subscribe, and as always, I'll see you soon.